You're listening to Capital Topics episode number 63. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. First, we'll give you an update on the result of active versus passive management for 2023. And next, for a second topic, we'll review the 2024 federal budget and the new rules that affect investors. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very well, thank you.
All right, so I'll start. For our first topic today, as we have done in the past, we will look at the results of the active management versus passive, or in other words, indexing strategies for 2023. This is an annual exercise that we perform. We look at the data from a report produced by the S&P Dow Jones Indices, which measures the results of the S&P indices versus active funds. This report is called the SPIVA Canada Scorecard.
Yes, François, but in addition to the SPIVA scorecard, we also look at the results of the Morningstar U.S. Active versus Passive Barometer report, which compares the performance of active funds against their respective passive peers. But what's different here, and again, this report is U.S.-centric, but we feel that it's more complete than the SPIVA report because Morningstar measures the rate of success of active managers against the results of actual passive funds, not the indices.
Yeah, James, the difference is subtle, but it's very important for listeners to understand. The Morningstar report studies the actual net of fees performance of investable passive funds versus active funds. On the other hand, the SPIVA report simply measures the performance of actively managed funds against the respective benchmark or index. The important nuance here is that a benchmark or index like the S&P 500 in the US or the S&P TSX Composite here in Canada are not investable without incurring fees.
Exactly right, François. Whether you are using an active or passive fund, you will always incur fees of some kind, fees for portfolio management, fees for administration, etc. Now that we have highlighted the main difference between the two reports, François, what are the results of the 2023 SPIVA Canada Scorecard?
Well, unsurprisingly, James, 2023 was yet another difficult year for active management in Canada. But before I look at this year's report or the 2023 report, I just want to set the table and go back quickly to 2022 results, which we covered in episode 51 of this podcast. I'm sure you remember that 2022 was a disastrous year for both the bond and stock markets, and contrary to active managers' narrative that they can position their portfolios to outperform in difficult market, well, the results last year were not so great. Less than half of active funds were able to beat their respective benchmark during that year.
Yeah, but the report also underlined that although it was a challenging environment in 2022, the markets gave active managers a lot of opportunities to generate relative outperformance.
Exactly. And as I mentioned, they did not generate that relative outperformance. So now for 2023, I'm sure our listeners will remember from podcast number 59 that the main indices worldwide delivered fabulous returns, double-digit returns for the most part. Despite this, active managers again failed to deliver since more than 3/4 of active funds underperformed their benchmark last year. If you look at the main four fund categories, which are Canadian equities, US equities, international equities, and finally global equities, active managers on an asset-weighted basis for each category underperform between 1.7% and 8.4% their respective benchmarks.
Wow, these are huge underperformance numbers. So François, how does the report explain this underperformance?
Well, James, the report highlighted that years of high benchmark performances usually coincide with greater active management underperformance. For 2023, the report states that, and I quote, along with solid index performance came positive skew in cross-section of constituents' return. In all categories, the majority of constituents trailed their benchmark's total return.
Okay, well, François, that's a lot of jargon. So let's try and explain it in simple terms for our listeners.
Yeah, sure. What they are saying, Jamie, is that most of the stocks underperformed their benchmark last year, which made it difficult to add value by stock picking. For example, in the S&P 500 index, close to 74% of stocks trailed the index, and in Canada, 60% of stocks trailed the S&P TSX Composite Index. So if you did not have the good stocks in your portfolio, you were bound to fail. That's what the report stated as the main reason for underperformance of active managers last year. But our listeners need to remember that over the long run, only a small percentage of stocks generate most of the performance in the equity markets.
That's a really key point, François, and investors and our listeners really need to remember that. François, I presume that the long-term results have not changed and they're still pretty disastrous for active managers?
Yeah, indeed, James. Over 10 years, most actively managed funds in Canada have underperformed their benchmark. For the 7 asset classes studied, underperformance ranged from 76% for Canadian small cap and mid cap equities to a high 98% for US equity funds. The annualized underperformance versus the benchmarks for the 10-year period ranged between a relatively low 48 basis points for Canadian small cap and mid cap equities and a high 437 basis points for global equity funds. The average underperformance for the 7 asset classes was 2.31%.
And that's over 10 years, which is a lot.
That's over 10 years. That's a lot of money on the table. Yeah.
François, what about the results in the U.S. Based on the Morningstar U.S. active versus passive barometer that you mentioned earlier?
Well, James, based on the report, actively managed funds and exchange-traded funds underperformed their passive peers again in 2023. Their success rate was slightly better than last year, with an average of 47% of active strategies beating their passive counterparts in the year, compared to 43% in 2022.
Okay, so François, isn't this what we expect from a simple coin toss, like 47%, when looking at short-term one-year results? What are the long-term results? I presume that it's pretty much the same as 2022.
Yeah, you're right, James. No big surprise there. Albeit a recent surge, actively managed mutual funds and exchange-traded funds continue to underperform their passive peers over the long term. The average success rate of the 20 different fund categories for the last 10 years is below 25%, meaning that less than 25% of active strategies were able to beat their passive counterparts during that period. There's also data in the report going back to 15 and 20 years, and as you would expect, the success rate is even worse there.
Are there any bright spots for active managers?
Well, James, there are fund categories where active management is doing somewhat better, but these are very niche categories like U.S. real estate, global real estate, and corporate bonds. In these 3 categories, the success rate of active management slightly exceeded 50% over 10 years, which is not that bad. One other thing that is worth highlighting, James, is that, and our listeners should retain, is that the success rate for active funds that had the lowest costs are generally much higher than the ones with the highest costs. For example, over 10 years, U.S. equity large cap blend funds with the lowest cost had a success rate of 18.6%, compared with only 9.3% for the funds that had the highest costs.
I'm sure these poor results won't help to slow the outflow of funds from actively managed funds to passive tools.
Yeah, I think you're right on that point, James.
To that point, our listeners should check out Raymond Carzaro, PWL Senior Researcher's latest report entitled The Passive versus Active Fund Monitor, which he publishes every year. And this report, he details the persistent outflow of funds from active management and the massive inflows into passive funds. Passive funds in Canada now have a market share of 16.4%, but we're still well behind the US, where the passive share is approaching 50%. And again, these are of managed funds. It's now actually at 47% in the US.
Right. Yeah, that's quite impressive. And I would add, James, that in the world markets, excluding North America, the market share of passive is also growing fast, as it had more than doubled in the last decade to reach 31%.
Yeah, that's an interesting number, François. I think something we talked about in the last couple of years on our podcast, where American fund managers control most of global equity funds. So I think it's a big influence of of American fund companies like BlackRock and Vanguard and others.
Yep, possibly. Yeah.
Again, I also think it proves that investors now better understand the benefits of indexing and passive management, and that ETFs are great tools to build robust portfolios.
Yeah, and I agree, James. It's very encouraging to see the growth in passive management. I'm just hopeful, however, that investors make good use of the tools and invest in a disciplined manner with an eye on the long term. I say this because investors' behavior has a meaningful impact on performance, whether you use an active fund or a passive fund. And we'll elaborate and come back to this topic in a future podcast. Okay, now for our second topic, we will do a review of the 2024 federal budget and the new rules that affect investors. As most of our listeners already know, the federal Deputy Prime Minister and Finance Minister, Chrystia Freeland, presented the federal budget on April 16th. The 2024 federal budget included several tax measures that will affect Canadian taxpayers. Some of the proposed measures impact the personal tax rules, and some apply to investment held in corporations. So, James, where do you want to start the conversation on that?
Well, Francois, we're recording today on April 30th, which is the last day people's taxes are due for Canadian tax residents.
Right.
The latest budget presented actually almost 2 months later than usual, and that's created other problems. This budget introduced many new measures that, well, in my opinion, reverse longstanding tax policies and economic tax thinking. The media is reporting that many investors are quite angry about the proposed changes, and I can understand why. It's a lot of confusion. I, for one, believe that these measures are very short-sighted and will chase out of Canada many very wealthy citizens who are paying astronomical amounts of tax. This at a time when we need them more than ever to help shoulder this enormous burden that we have.
Yeah. James, why don't we look at the details and look at the tax changes affecting individuals and their investments?
Okay, so that's a great place to start, François. For individuals, the good news is that there are no changes in the personal tax rates, other than the graduated rates thresholds being indexed. The bad news is the big change in the capital gains inclusion rate. The amount of capital gains subject to tax will be increased from 1/2 to 2/3 on capital gains that exceed $250,000 when realized after June 24th, 2024.
Okay, and how will the higher capital gains inclusion rate affect capital losses?
Well, capital losses realized prior to the rate change will fully offset an equivalent capital gain realized after the inclusion rate change. Net capital losses of prior years would continue to be deductible against taxable capital gains in the current year by adjusting their value to reflect the inclusion rate of the capital gains being offset. So this actually makes your loss carry forwards that you have, those amounts are now more valuable after the June 24th, again, just for the gains in excess of $250,000 in a given year.
Yeah. The higher tax rate adds up to almost 9% more for taxpayer at the top marginal rate in Ontario and Quebec. Investor will need to look carefully at their unrealized capital gains in their taxable accounts to see if they should realize gains before the June 25th deadline.
Well, indeed, these new rules completely change tax planning strategies for individuals in Canada. PWL Research has developed a great tool to simulate if you should realize the gains or defer them. Interestingly, in most cases, it is still best to defer.
Mm-hmm. Why is that, James? Is it a simple matter of time value of money?
Exactly, François. If you realize the gain now, you've got to pay the tax immediately in the current year or by April 30th, 2025. And so you have less money after tax to reinvest. So this can really be a hard sell because most people, and psychologically, the idea of paying tax in advance is really against their nature. So this is basically, you typically try to avoid or minimize tax wherever possible. So if you defer realizing the gain, then really you're only paying the tax in the year you actually dispose of the asset.
Yeah, deferring tax is, as most of our regular listeners know, a major benefit of our passive buy and hold broad market investment strategy. strategy. For most of our clients, continuing to defer tax will make the most sense for taxable accounts. On another front, the new rule will make things complicated for tax reporting. In the 2024 tax year, you will have to report gains at 50% for the period ending at June 24th. After June 25th, the gains over $250,000 will be taxed at the 2/3.
Indeed, this will make things more complicated. We're going to have to identify capital gains and losses realized before the effective date and those realized after the effective date. For example, taxpayers would be subject to the higher inclusion rate in respect to the portion of their net gains arising after June 24th. Again, that excludes this new $250,000 threshold. To the extent that these net gains are not offset by net loss incurred in 2024 before June 25th or any other taxation year.
Yeah. For more clarity, the annual $250,000 threshold for individual would be fully available in 2024, so it would not be prorated, and it would only apply to net capital gains realized after June 24th. Jane, what are some of the other measures in the budget that affect individual taxpayers?
Well, there's one other change that's linked to the increase of capital gains inclusion rate, and that impacts employees where their employer granted them stock options. And again, it's a very small subset of Canadians, and it's mostly senior executives that get these grants. So when the employee exercises a stock option granted by their employer, there now will be a 1/3 deduction of the taxable benefit above $250,000 to reflect the new capital gains inclusion rate. For situations where the taxable benefit up to a combined limit of $250,000, again, for both employee stock options and capital gains combined together, taxpayers will be entitled to a deduction of 1/2. So again, fairly complicated stuff, but for employees who have stock options.
Yeah. What about the lifetime capital gains exemption on gains realized on the disposition of qualified small business corporation shares? Any changes there?
Yes, François, there's good news here for entrepreneurs who own shares in their company and sell them. The lifetime capital gains exemption, or the acronym LCGE, will be increased from $1,016,836 to a round number of $1,250,000 on gains realized on the disposition of qualified small business corporation shares. And the tax code spells out what that is, and it also applies to qualified farm or fishing property. Again, after June 24, 2024, indexation of this lifetime capital gains exemption would resume in 2026.
Yeah, I believe there's more in the budget for entrepreneur, James. Anything there?
Absolutely. They've introduced another complicated but interesting concept. So starting in January 2025, the budget introduces the new Canadian Entrepreneurs Incentive. So capital gains realized on the disposition of shares of a private corporation that meets certain conditions, and that's where the complexity comes in, will be subject to an inclusion rate of only 1/3. This measure would apply in addition to any available capital gains exemption. The limit will be phased in by increments of $200,000 until it reaches a lifetime limit of $2 million. These complex rules appear generous, but again, the whole bunch of types of corporations are not included in being eligible for this benefit. So again, you'll really require the help of a tax accountant to plan for this one.
Yeah. What about registered plans?
Not a lot of major news here, but there's some interesting stuff, particularly to help the younger people buy their first home. So there's no changes to the tax-free savings account, the RSP, or the RIF rules. If you recall, we did a podcast on RIFs. We were expecting last year that they would, make adjustments to the minimum withdrawal percentages, but no news there. There are changes to the home buyers plan withdrawal limit. So that's the really big news. It will be increased from $35,000 to $60,000 for withdrawals made after the date of the budget, April 16th, 2024. So that's good news. So a couple together would be able to pull out $120,000. Also, the 15-year repayment period will be temporarily deferred by an additional 3 years for participants making a first withdrawal between January 1, again, backdated to 2022, and then all the way out to December 31st, 2025. So there's some technical changes to RESPs that involved funding for parents of children who don't have means, where the credits could go in. We'll get into that in a future podcast when we do an update on registered education savings plans.
Yeah, that's a lot of changes there. Is that it on the personal tax side?
No, I have a few more things. Again, always more complicated. And so the Fed's introduced more tweaks around the edges of the major changes to the alternative minimum tax, or AMT, regime introduced in 2023 and applicable now in 2024. Again, applies to very few Canadians. Again, very complicated rules. For instance, they will allow for an increase to the charitable donation tax credit and the allowance of certain other credits in the calculation of the AMT. The 2024 budget proposes that the tax treatment of charitable donations be revised to allow individuals to claim 80% instead of the previously proposed 50% of the charitable donation tax credit when calculating alternative minimum tax. And again, donation strategies are something that is a really, really big area of philanthropic planning for high net worth clients. So again, I think there got a lot of pressure around that one. Finally, there's another tweak for the benefit of the mining industry. The flow-through share mineral tax credit will be extended for an additional year, again, covering flow-through share agreements entered into on or before March 31st, 2025.
Okay. I think we've covered everything for personal tax changes. Now let's turn to changes for investment corporation. What are they proposing, James?
Well, here they're really turning the screws. For businesses, again, like with personal tax, there's no actual change in the corporate tax rates. And a reminder for our listeners, a lot of high net worth people who have businesses, pro corps for professionals, they save money through their corporations. And so the investment income on these public marketable securities portfolios we manage, there's only one tax rate, a top rate of 50.17%, for example, for corporations based in Ontario and in Quebec. And like personal tax, the capital gains inclusion rate for corporations trust will be increased from 1/2 to 2/3 on capital gains realized after June 24, 2024. So unfortunately for corporations, there's no relief from the new higher inclusion rate. As stated earlier, for individuals who realize gains is under $250,000, you'll still be a 50% inclusion rate. So here there is no $250,000 threshold. So this is really forcing a lot of tax accountants to say, well, wait a minute about our planning, because the saving through your holding company has been a time-honored, a long-term retirement planning strategy for saving. So that's a really tough one.
Yes, James, but I understand after years of collaborating with tax specialists that the Canadian tax code is structured to ensure integration. In other words, a dollar earned personally will equal to a dollar earned in a corporation and then paid out to the shareholder.
Yeah, and so that's where the problems arise, because now this is blowing up the concept of integration, and there's been no technical notes with this budget. So this has really got a lot of tax professionals really, really upset and worried, because the timeline to make decisions is June 24th, right? So we've yet to see what I would call thorough analysis from tax specialists. We've seen some spreadsheets, but again, until they get the actual technical details from the government in terms of the legislation, we have to hold back on final opinions. So again, this higher inclusion rate is really putting a monkey wrench in terms of long-term retirement planning for entrepreneurs and professionals. So again, let's hope that they're going to come with these technical details in short order, and we can report back to our listeners on the impact.
Yeah. So James, is it fair to say that the really big change is all about the capital gains inclusion rate increasing to 2/3 from 50%? Effectively increasing the capital gains tax rate by 9%. On the other hand, the feds make the case in the budget that this will only apply to a very small percentage of Canadian taxpayers.
Yes, François, according to the government, and again, that 9% increase is absolutely astronomical, which is why they're bragging about how much money it's going to raise. But again, that's a short-term mindset, in my opinion. So again, getting back to the government's budget document, they show statistics that it will only affect 0.13% of Canadians with an average income of $1.4 million. Therefore, the hike is defended in part to ensure that the wealthiest Canadians pay their fair share.
Yeah, I really don't like this approach as it creates a lot of anger in the high income earners who pay a disproportionate amount of income tax, I believe. We covered this topic in podcast episode number 57, published last October, when we discussed Canada's tax system. Do high earners pay their fair share of taxes?
And I agree with you, François, about not liking this because it gets perpetuating the notion that high earners aren't paying their fair share. And so in that episode of our podcast, we reviewed the findings of a research bulletin from the nonpartisan Fraser Institute called Measuring Progressivity in Canada's Tax System 2023. The report, as you recall, François, concluded that high-income earners in Canada pay a disproportionately large amount of tax. The Fraser Institute's 2023 report suggests that the top income-earning families, those making just under $250,000, pay the majority of Canada's taxes. But there's also similar data that's been published by Statistics Canada on those same high income tax payers. And for example, in 2021, Statistics Canada's data shows that the top 1% income group paid a whopping 22.5% of all income taxes, but accounted for 10.4% of the share of the country's total income. We can debate income inequality and, the wealth concentration effect. The reality is in Canada, unlike the US, that they pay a ton of tax. So the top 10% income group, if we widen it from the 1%, he paid 54.4% of all income tax, but had a share of the country's total income of 34.4. So again, that argument that, wow, the wealthy are not paying their fair share, the data doesn't support that.
The federal government lays out its case for what it believes is not fair, particularly when it comes to taxes on capital gains. I quote the budget paper: while all Canadians can benefit from capital gains tax advantage, the wealthy, who tend to earn relatively more income from capital gains, disproportionately benefit compared to the middle class, the budget said.
Yeah, well, there was a great article in the CBC News Online website, and they quoted Trevor Toome, a professor of economics at the University of Calgary. And we've quoted him before in the last year. I really think this guy's a really bright guy. And his quote is the following, and I'll share it with our listeners. That word fair is completely subjective. What's needed in any kind of statement around what is or isn't fair is clarity around what the person means when they say that word. Now, let's go back to the Fraser Institute, and Jake Fuss, who's Director of Fiscal Studies. He's also quoted in the article, and he says it's kind of very vague in terms of what governments and policy makers actually mean by fair share. So while these tax changes may impact the very wealthiest, Fuss suggested that is often overlooked is how much high-income earners are actually paying in taxes, and that's the point that's important. The dollar number. Percentages are one thing, but dollar numbers is another, and we can't afford to lose these citizens.
Right. So, James, let's wrap up the review for our listeners. There will be a lot of investors reaching out to their financial and tax advisor to get clarity on how to optimize their situation under these proposed rules. This may well generate significant extra revenue in 2024 for the governments. But you really must wonder about the future. There will be significant unintended consequences, and high-income earners are going to try hard to minimize the impacts.
Well, again, people, basic human nature, if you can avoid a tax or not pay a tax legally, then you're going to try and do it. Unfortunately, these new rules are going to force people to make fairly harsh, severe decisions, which I think are unfortunate. So again, the key thing here for business owners, near-term strategies could involve selling investments or shifting them to personal accounts to take advantage of lower capital gains tax rates before June 25th. For individuals, options may include selling large appreciated assets such as rental properties or vacation homes, or staggering the sale of securities across more than 1 year. We're seeing all kinds of things being published, François. So, we hear about how there's panic in cottage country with people rushing to try and sell. It made such a volume of people trying to sell that the price you end up losing. So you really got to be careful and do proper thinking about all of this. So again, some Canadians may also choose to accelerate their estate planning because, again, the deemed disposition tax You got 9% more tax. This is a big number. So a lot of older Canadians may want to start, crystallizing, benefiting every year, $250,000 and pre-gifting inheritance to their beneficiaries. So a lot of planning work is going to be required there. And here's the scary one. Some Canadians, very wealthy, may consider moving to a country with lower taxes.
Yeah, absolutely. In Canada, taxes are based on residency, not on citizenship like in the US. So that worries me a bit. If we lose too many of these high income earners, then we lose all the future cash flows and taxes that they would have paid in Canada.
I completely agree with you, François. These new rules put the country at high risk for losing many very wealthy taxpayers. I guess our listeners will sense the frustration in my voice today. To conclude, for all our listeners, we recommend consulting with your financial and tax advisors and crunch the numbers because everyone's situation is different. Again, don't panic. For most people, deferring the tax is going to make the most sense, is what I suspect the ultimate outcome is going to be. Canadians should also consider that the changes may not be forever. That's the hope. The capital gains inclusion rate was first introduced in 1972 at 50%. It was increased to 2/3 in 1988. And then in the 1990s, they increased it to 75%. But then they figured their ways. And again, people forget this stuff, right? But in the early 2000s, the front cover of Maclean's magazine was, hey, everybody's moving offshore. Well, that's when people looked at the high cost of capital gains. So, then they dropped it to 50 and then things normalized. It didn't make sense to go offshore because the tax rate was more balanced. And again, so in 2000, they dropped it twice, I think a few months they dropped it to 2/3 and then to 50% where it's been since then.
Yeah. Well, the big unknown here is whether the increase in the inclusion rate will survive future change in government. So thank you, James, for sharing your expertise and your knowledge today.
My pleasure, François. Thank you.
So that's it for episode number 63 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on June 6th. In the meantime, make sure to consult Capital Topics website for our latest blogs. See you soon.